reform that we need immediately, closing the revolving door between Wall Street and Washington.
Hasn't there been a similar push, though, to stop former members of Congress from becoming lobbyists?
Yeah, but it's not happening. And I doubt this will happen either, because it's in the lawmakers' financial interest to keep the door revolving. And the result is that Washington has become an arm of Wall Street, passing laws to make the bankers richer rather than protecting average citizens. I'm proposing a law that bars government workers from accepting a job on Wall Street for 5 years after they leave public service. Of course, some people will say that means we won't get the best and the brightest in those jobs. But considering the best and the brightest keep ripping us off, I'll settle for competent and law-abiding.
Okay, but the truth is we can pass all the laws we want. And there are laws now. They're supposed to protect against securities fraud and similar crimes. But the truth is enforcement here has been pretty lax, right?
Exactly. That's the third problem we need to address. Regulations have to be enforced to the full extent of the law. Anti-fraud statutes were violated repeatedly over the past decade, yet no one is in jail.
Who would be any better?
Well, how about William K. Black? He was a senior regulator during the savings and loan crisis of the 1980s. Now he's a professor at the University of Missouri, and he's author of the book, The Best Way to Rob a Bank is to Own One. Black recently testified about the need for financial reform before Congress. But, of course, the Obama administration has ignored his advice, and to me, that's an indictment of how corrupt the White House is on this issue. But heck, I'd even take Eliot Spitzer at this point. Sure, he consorted with prostitutes, but he cost us a lot less money and went after a lot more bad guys than the insane clown posse of Summers, Geithner, and Rubin.
Well, that's one suggestion. Another that I've been hearing a lot about is the outlaw of credit default swaps. Now, where do you stand on that issue?
Well, I think that might be a good idea. Credit default swaps, or CDSs, are legalized institutional gambling. They add nothing to the national economy, and we don't need them. I say we can get rid of them. But we could talk about trading instruments or specific policies until we're blue in the face. It won't make a whit of difference for one simple reason.
And that is?
Money in politics. Politicians will never crack down on Wall Street because they need campaign contributions from Wall Street to get elected. Barack Obama has made a huge amount of money from financial institutions, but he's not the problem. Whoever replaces him, Democrat or Republican, will be subject to the same financial pressures. We need a constitutional amendment banning money from politics. We need true campaign finance reform. We need to finance political campaigns with public funds.
So, wait a minute, Sean, you're saying that taxpayers should foot the bill for political campaigns?
Well, it would be expensive, but it would cost us a lot less than the outrageous amounts of money, public money, that are being funneled away under the current system. Now, it'll take elected officials to enact these changes, so I'm under no delusions that they'll actually happen. But if we really want to reform our financial system, this is the way to do it.
Okay, great suggestion. Sean Broderick, thanks so much for being here.
Thanks for having me on.
Well, our next guest might disagree with some of those suggestions. Monty Agarwal has 15 years of experience at Wall Street banks and hedge funds. He has actively managed capital for more than a decade. Okay, Monty, what do you think of Sean's recommendations here for reforming the financial system?
I do agree with his first point that we should reinstate Glass-Steagall. It worked for 65 years. It was repealed because the Wall Street banks complained that they couldn't compete with the European banks. But the repeal led to abuses, and those abuses happened because of a lack of risk management. However, I don't place all the blame for that on the banks. I blame the government's too-big-to-fail mentality. Of course, these institutions took irresponsible risks because they believed Washington would just bail them out. And they were right.
Okay, what about the suggestion that credit default swaps should be outlawed?
I completely disagree. Credit default swaps are an important tool for keeping the markets in check. They're a way for investors to bet on the likelihood that a company or a country will default on its debt. And that is essential for the healthy functioning of the markets. It's the only mechanism that the market has for making sure that the company that should go bankrupt does go bankrupt.
It sounds like, Monty, you think the free market should be allowed to just function on its own without any interference from the government.
For the most part, yes. Any financial reform that takes away from pure free market capitalism will just end up creating larger and larger bubbles in the future because the checks and balances that exist in a free market will be taken away. And we're seeing a perfect example of that right now. By stepping in to bail out the big banks during the last crisis, Washington created massive deficits for itself. And that's leading to a second crisis that could be even worse, the sovereign debt crisis.
So you think all those big banks and insurers, guys like Citigroup, Bank of America, AIG, they should have been allowed to fail?
Absolutely. If they were going to fail, they should have been allowed to fail. Why? Because there were 500 other smaller banks who didn't make the dumb investments that these guys did. And they would have stepped in and filled their shoes. It might have taken a few months longer, but the financial system right now would be in a much healthier state. Prudent risk management should be awarded, and poor risk management should always be punished. Free markets without government safety nets would ensure that. The markets should be able to do what the markets are going to do, and if that means a wave of bank failures, so be it.
Do you think the government should have any role at all?
The only role that regulators should have is to make sure that there is an even playing field and that people are playing by the rules. Outside of that, don't get in the way.
Monty, you said the only job of regulators is to make sure people play by the rules. Okay, what should those rules be?
I think they should be very simple. One, increase transparency. At the end of the day, investors are the best regulators. If the investors are well informed of the risks they're taking, they will make better judgments. Which brings me to my second rule. Investors need to be much better educated so they can make rational decisions. But unfortunately, most investors, even the supposedly sophisticated ones, have really no idea what they're doing. And that is what leads to asset bubbles. People chasing after huge returns, investing in products they don't understand, with no heed paid to the risks involved.
So, Monty, you put the responsibility for regulating the markets more on the investors than on the government.
Absolutely. When the government steps in, it usually does so with reactionary measures that make the system weaker instead of stronger. And that'll be the case if Washington forces the Wall Street banks to split off their derivatives trading units. See, the reason commercial banks are able to make loans is that they can hedge the interest rate risk themselves. In fact, they have to hedge in order to protect themselves. So if you split the derivative units away, commercial banks would have two choices. One, to keep unhedged risk on their books, or two, go to an outside party to hedge those risks. Of course, they're going to want to hedge their bets, so suddenly they're paying up to an outside third party. And if that happens, commercial banks are going to pass along those extra costs to their customers. That makes credit more expensive, and it hurts Main Street while really doing nothing to reform Wall Street. So this bill will not just be ineffective, it will actually make things worse.
Okay, Monty Agrawal, thanks so much for being here. Well, as you just heard, there's some disagreement about what should be done to fix our financial system or whether anything at all should be done. But what everyone seems to agree upon is that the types of reform Congress is proposing will not help. It's likely to hurt some banks more than others, and we've told you which stocks to avoid at all costs. It's also likely that the entire sector is in danger of another collapse, and that collapse may bring the broader market down with it. Your top priority, of course, is protecting yourself. Over the next couple of weeks on Money and Markets, we're going to give you strategies for doing just that using currencies and precious metals. I'm Jamie Holmes, and now, Martin Weiss.
Regulatory reform does little to make your bank safer. It does nothing to stop the Fed from creating another boom and bust cycle. And it does nothing to reverse the path of fiscal madness that our federal government has embarked on. If Congress really wants to reform the financial system, it must split apart consumer banking and speculative trading. It must stop the Fed from creating more bubbles, and it must clean up our fiscal mess. I have no illusion they will act promptly on any of these three fronts. And until they do, you must act on your own. Look, in Europe, the first victims of the sovereign debt crisis were investors in long-term government bonds, and soon the crisis spread to investors in the currency and stock markets. So take that as a fair warning. Don't wait for the sovereign debt crisis to strike here. Get out of long-term bonds. Protect yourself from attacks on paper currencies, and reduce your exposure to most stocks. I'm Martin Weiss. I'll see you here again next week.